Welcome to the deep dive. Today, we are taking a close look at the recent Fastenal 2025 third quarter earnings call. Now, you'd typically think, right, that industrial distributors would struggle when the global economy slows down. Yet Fastenal just delivered double-digit growth. And this is in an economy that's really screaming contraction.
Yeah, it really does seem to defy gravity, doesn't it? We should probably set the scene a bit for you. Fastenal is deep in the industrial world, and, well, that landscape has been pretty hostile lately. You look at the Purchasing Managers Index, the PMI. It's a key measure of industrial activity, and it averaged at a very sluggish 48.6 during the quarter.
Right, and anything below 50 on that index means contraction, not expansion.
Exactly. So whatever they achieved, it wasn't because the economy was lifting them up.
And that's the core puzzle we really want to unpack today. What's our mission? We want to get beneath those headline figures, pinpoint the internal drivers. What was the strategic playbook that generated this, frankly, exceptional performance? Because the numbers themselves, they're pretty stunning. Q3 net sales, $2.13 billion. That's up 11.7% year over year.
Wow, yeah.
And net income, diluted EPS, they were right there with it. Both grew over 12%. EPS came in at $0.29 per share, and that's adjusted for the stock split they did back in May.
So seeing that kind of performance, especially in this environment, it tells you straight away the growth wasn't macroeconomic. It had to be, well, what they call self-help. They were just taking market share from competitors.
And you can really see the pace of that share gain in their daily sales rate, the DSR.
Yeah.
Their Q3 DSR growth was 11.7%. Okay, that matches the net sales number. But if you zoom out a bit, look at the year-to-date DSR growth, so January through September.
Yeah.
It jumps to 15.9%.
15.9, okay, that's significant.
It really is, especially when you compare it to their long-term historical benchmark, which is around 9.5%. That huge difference. That's pure intentional strategy at work.
You can see where that strategy is hitting hardest. It's with their biggest customers. This looks like it's all about deepening those high-value relationships, not just, getting thousands of small accounts.
Exactly. If you dive into their customer site data, you see this deliberate focus on the high-spending accounts. The number of customer sites spending over, say, $10,000 per month grew a pretty solid 8.1%.
Okay, that's good growth.
But here's where it really accelerates. Look at the on-site-like locations. These are the big ones. Account spending over $50,000 per month. They grew even faster, up 15.4%.
15.4% for the biggest accounts.
Okay.
So the takeaway for you listening is that Fastenal is putting its resources, its people, its tech, its inventory where they get the best return. These bigger locations, they have higher switching costs too. And these $10,000 plus sites, they're now pulling in, 82.1% of Q3 sales?
Yeah, 82.1%. That's up quite a bit from 79.4% last year.
So it just confirms it. That focus on locking in the large customers, that's the main engine driving things.
They also mentioned something else interesting, strategically diversifying their market exposure, which sounds like a smart defensive move in a downturn. They targeted what they called non-traditional markets after the pandemic, specifically thinking about healthcare, education, government, and also warehousing and logistics.
Yeah, that's a classic move, right?
Right.
To balance out the cyclical exposure. These sectors, they still need huge amounts of MRO spend, maintenance, repair, operations stuff, but they aren't quite as tied to the ups and downs of industrial production cuts. Like one of their executives said, these segments might not boom like heavy manufacturing, but, and this is critical, they don't bust as hard either.
No.
So they provide that resilience, that stability when the PMI is kind of stuck below 50.
Okay, so generating more sales volume is one thing, but the real test is turning that into better profit, right? How did the operational side support this, especially thinking about their fastener expansion initiative? What was that about?
Right. That initiative sounds like it was a really big coordinated effort. Involved sales, supply chain, operations, all working together. The goal was really driving margin expansion. And a key part was making what they called an accretive inventory investment, basically building up stock. They focused specifically on fasteners, which is their highest margin product line, to make sure they had immediate availability across their network.
Okay, but hang on. We just established the economy is contracting, industrial sentiment is low. Usually in a slowdown, companies try to slash inventory, right? Conserve cash, avoid getting stuck with stuff they can't sell. So they deliberately increased inventory investment. Isn't that, well, financially risky?
It's definitely a calculated risk, yeah. But the payoff they were betting on was market share capture and, importantly, margin control. And looking at the margins, it seems like it worked. Gross margin went up 40 basis points year over year, hit 45.3%. And they said this initiative was a primary driver.
Okay, so what's the logic there? How does holding more inventory help margins?
Well, the underlying logic is pretty straightforward, actually. If they have the right fasteners, the high-demand stuff, ready to go immediately, their sales teams can serve customers faster than competitors who might be caught short. That speed lets them grab share. And, crucially, it also lets their own purchasing teams buy in an orderly fashion, as they put it, which probably means getting better terms, better pricing power from their suppliers because they're buying proactively, not reactively.
Ah, okay, that makes sense. Better purchasing power helps the margin. And that efficiency, it flowed right down the income statement, too. Operating margin also improved 40 basis points year over year, hitting 20.7%. We should probably note, though, that employee-related expenses were up, what was it, 12.9% year over year?
Right, but in this context, that's actually a good number to see. They said it was due to a necessary reset of bonus and commission programs.
Mm-hmm.
Basically, they hit double-digit growth, they outperformed their peers, so they were paying for the success they just generated, rewarding the team.
Fair enough. Okay, let's shift gears a bit and look at the foundation of that customer lock-in we talked about. Technology. Their digital footprint isn't just like a website for ordering. It feels more like a force multiplier for integrating with customers.
Oh, absolutely. It's becoming the defining differentiator for their whole business model, I think. We're talking about their FMI technology, Fastenal Managed Inventory. That includes their whole ecosystem of proprietary devices. Fast Vend, Fast Bin, and Fast Talk.
Right. For you listening, if you're not familiar with all the FAST acronyms, maybe break down what that tech actually is. What does it do?
Sure, happy to. Think of it like embedding Fastenal supply chain right onto the customer's factory floor or facility. Fast Vend, that's basically a smart vending machine. It manages usage of high-cost items like safety glasses or cutting tools and tracks exactly who takes what. Fast Bin, these use weight sensors. They sit under bins of bulk items like fasteners and automatically monitor inventory levels. No more manual counting. And Fast Stock, that's kind of the software brain behind it all. It takes the data from Vend and Bin and automates the replenishment process.
So it's not just about convenience then.
Not at all. It's creating really powerful physical switching costs.
Yeah.
I mean, once you install, what is it now, nearly 134,000 of these weighted devices globally,
Yeah, that's the latest number.
pulling that system out becomes hugely expensive and disruptive for the customer. They get baked into the customer's
Ah.
workflow.
And the numbers definitely show this is accelerating their growth. Sales through FMI tech, that was 45.3% of total sales in Q3. That's up from 43% a year ago. But even more striking, look at the daily sales rate through FMI. That grew almost 18% year over year.
18%.
Yeah, significantly faster than the company's overall average growth of 11.7%.
Yeah.
So that embedded tech is clearly driving the fastest expansion.
And if you add in their traditional e-business like website orders, the whole digital footprint combined pulled in 61.3% of their total sales this quarter.
61%. That's staggering integration.
It really is.
Okay, now let's tackle the pricing environment. It sounds like it was pretty complex with tariffs, inflation, all that stuff. Pricing contributed, what, 240 to 270 basis points to growth? Which actually was a bit lighter than they'd expected earlier, right? They were aiming for maybe 3% to 5%.
It was lighter, yeah. And that seems to have been a very deliberate strategic decision, not just, an accident or an oversight.
How so? They actually delayed a pricing action, didn't they, by about 30 days in Q3. Now, normally, in a period with ongoing inflation and tariff pressures delaying price hikes, yeah, well, it seems like it could hurt margins. How does holding back on pricing actually build value or help gain share? Wouldn't it just eat into the margin gains they got from that fastener initiative?
It seems counterintuitive, I know. But the thinking appears to be focused on building trust. And trust is really the ultimate long-term currency in these distributor relationships. By slowing down that pricing action, they gave their sales teams more time. Time to have more thoughtful, maybe less confrontational discussions with customers, which meant they could work with the customer to find effective substitutions, maybe different products, or explore better sourcing options to try and mitigate the cost increases, instead of just passing the whole burden straight on.
Ah, so it's about playing the long game. Show the customer you're trying to help them manage costs, not just hit them with increases.
Exactly. That kind of responsiveness builds long-term loyalty. It probably helps guarantee they keep the customer and keep that valuable technology lock-in, especially if a competitor might have just forced a price increase and potentially lost the account over it.
And you can see that success in mitigating costs reflected in their revised outlook, too. Their Q4 pricing goal for like parts, they lowered it, now targeting 3.5% to 5.5%, down from an earlier expectation of maybe 5% to 8%. That pretty clearly suggests their sourcing flexibility and those substitution strategies are actually working, buffering some of that inflation and tariff pressure for customers.
And you also have to consider the broader market context here. There's definitely this sense of price fatigue out there. Customers are just, well, exhausted by constant hikes, and they're expressing a lot of uncertainty about trade policy, tariffs, all that's impacting demand expectations as we look towards, say, early 2026. Fastenal seems to have read that room and responded by prioritizing that trust factor over just maximizing short-term price realization.
Okay, one last major piece here. There's a big structural shift coming in their reporting, starting in November. This sounds pretty significant for anyone trying to track the company's resilience going forward. They're moving away from the old product categories, fasteners, safety, other stuff, and shifting to reporting sales based on direct versus indirect materials.
Yeah, this is a really important change. It promises to give much clearer visibility into the actual nature of their business. Before, they kind of had to estimate some of these splits. Now they're going to segment sales based on how the customer uses the product.
So why does this matter so much for you, the listener? What does this new data tell us about Fastenal's business that maybe we didn't fully grasp before?
Well, fundamentally, it tells us exactly how much of their business is really tied to that cyclical industrial activity we keep talking about. The new data reveals that direct materials, so think items used directly in production, like OEM fasteners or cutting tools for manufacturing lines, those make up 38.8% of their year-to-date sales.
Okay, so just under 40% is direct materials tied to production. What's the rest then?
The remaining 61.2% is MRO spend, maintenance, repair, and operations, or what they're calling indirect materials. This is all the stuff needed to keep facilities running: janitorial supplies, safety gear, spare parts for machines, stuff that's needed whether production is booming or contracting.
Oh, I see.
The purpose of getting this clarity is huge. It effectively separates the part of the business that correlates highly with cyclical indicators like the PMI, that's the 38.8% direct piece, from the part that should be far more stable and resilient, the 61.2% MRO piece. This should allow for much better forecasting, both internally and for analysts. And it helps ensure their sales teams are focusing efforts appropriately on that big, resilient MRO opportunity.
So it basically confirms that almost two-thirds of their business acts as a pretty substantial buffer against the industrial slowdowns we've been discussing. And even though direct material margins might typically be a bit lower.
Right, but the cost structures are often lower too, because it's more planned activity.
Yeah.
Ultimately, the focus stays on return on invested capital, ROIC, which, by the way, was still very strong at 30.2% on a trailing 12-month basis.
Impressive. That ability to grow the capital invested while keeping those kinds of returns is really the bottom line measure of success here.
Absolutely.
Okay, so stepping back, let's try to summarize the core strategic playbook for you. Fastenal managed to achieve these really exceptional results in a tough contracting industrial environment. It wasn't luck. It looks like it was about prioritizing internal control and execution. They built this powerful technological moat, that FMI footprint that's accelerating. They paired it with aggressive operational excellence, like that fastener expansion initiative driving margins. And they backed it all up with really thoughtful share-gaining customer management and pricing strategies. Essentially, they generated their own growth when the market really wasn't giving them any help.
Yeah, that sums it up well. And that strategic shift in reporting, the direct versus indirect split, it leads us right into our final provocative thought for you. This new visibility confirms that a huge chunk, 61.2% of their business, is this resilient MRO indirect spend. That seems key. So the question is, given that Fastenal keeps investing heavily in technology, in FMI devices, in IT, and in massive new distribution hubs like the ones in Utah and Atlanta, how powerfully will this increasingly large, resilient, technology-driven MRO segment buffer them against any further volatility or maybe even prolonged stagnation in that traditional manufacturing cycle as we move into 2026? Will that MRO moat be strong enough to deliver yet another year of double-digit growth if, say, the PMI stays stubbornly below 50?
That's a vital question for anyone tracking the industrial space or investment in distributors, something to really mull over. Thank you for joining us for this deep dive. We'll catch you next time.